Welcome to the restaurant entrepreneur's dilemma. You've built something truly special. Your dining rooms are full, your team runs like clockwork, and your P&L shows black ink every month. But here's the uncomfortable truth I learned the hard way. The metrics that get you through daily service aren't the metrics that open doors to growth capital. At first glance, a restaurant can look healthy because sales are solid, guests are happy, and a few locations are performing well. But sophisticated investors are asking a deeper question. Are these results durable, benchmarked, scalable, and supported by disciplined financial infrastructure? In today's deep dive, we're unlocking what investors actually scrutinize when they evaluate restaurant brands and exposing the four critical mistakes that keep even profitable operators from scaling their vision. So here's the million-dollar question that emerged from industry research. What creates the massive disconnect between operational profitability and investment attractiveness? Why do successful, cash-flowing restaurants often hit a funding wall with sophisticated private equity? The answer isn't about working harder, it's about measuring differently. While you're focused on today's food cost percentage or this week's labor hours, investors are running a completely different calculus, one that predicts whether your concept can multiply across markets without multiplying your problems. Growth capital is not won by surface-level success alone. It is won by proving that your economics hold up under comparison, under pressure, and across multiple units. The numbers you use to run your restaurant in a vacuum are not contextualized for aggressive growth, leaving serious investors completely uninspired. Here's the critical gap in most operators' approach. They manage their restaurants as isolated islands rather than as data points in a competitive ocean. Operators make a massive mistake by conflating total company profitability with individual store health. You might have 3-star locations practically minting money, blinding you to the fact that 2 others are bleeding cash, while lean corporate overhead masks the damage. You can recite your prime cost percentage from memory, sure, but that's measuring in a vacuum. Without benchmark comparison, without context to top performers, without stress testing your assumptions, you can't prove your concept is built for multi-unit expansion. Investors see right through this facade. They normalize your numbers, compare them, strip out outliers, and ask what happens when growth is slower than expected. This island mentality might keep your business afloat, but it creates what investors call unquantifiable risk. To bridge this gap, the breakthrough methodology isn't about abandoning your current metrics. It's about contextualizing them within 4 strategic pillars. First, benchmark your prime cost against top performers rather than treating your own number in isolation. Knowing you run a 62% combination of food and labor cost means absolutely nothing without that competitive context. Second, dissect your profitability down to the store-level margin to expose true unit economics and prove that each unit stands on its own economic foundation. Third, treat rent not as a fixed cost, but as a stress-tested percentage that can make or break expansion assumptions when sales miss projections. And fourth, position debt as a strategic tool with restraint, tying borrowing to conservative assumptions instead of best-case expansion dreams. But here's the crucial innovation. Each pillar requires operational infrastructure, technology systems, data visibility, and supply chain control to become investor currency. What makes this approach compelling is that it connects metrics to systems, turning financial performance from abstract numbers into evidence of operational maturity. Let me walk you through the concrete findings that separate capital-ready operators from the rest. The standout result is that investor confidence rises when financial performance is both visible and explainable at the unit level. When you benchmark that 62% prime cost against top performers in your segment, that 3-point gap isn't just efficiency, it's a $300,000 profit opportunity on a $10 million business that investors can immediately calculate. On store-level margins, sophisticated buyers don't average your locations. They peel off your star anomalies and worst performers to scrutinize the middle 3 locations because those represent your repeatable model, your true consistency. The rent discovery was stark. That gorgeous new location projected at 8% rent ratio becomes a 12% anchor at just 2/3 of expected sales, turning ambitious growth into a pattern of flawed assumptions that murder unit economics. And regarding debt, the sweet spot is 2 times EBITDA. Anything beyond that handcuffs your valuation, eliminates strategic options when markets tighten, and creates pressure instead of preserving flexibility for future fundraising. Now, let's explore the real-world infrastructure implications and practical applications. For restaurant operators, these metrics shape everyday decisions long before any investor call begins. You can't benchmark prime cost without inventory systems that catch variance at the ingredient level and purchasing platforms that give you spend visibility across your entire supply chain. Store-level margin optimization demands flexible labor models that flex down during 2 p.m. lulls and surge up for Friday rushes, plus right-sized footprints that generate revenue across multiple day parts to prove your design choices are actually repeatable. Managing rent risk requires brutal honesty in your pro formas, stress testing new sites at 75% of projected sales, and the discipline to walk away from gorgeous locations that don't meet your assumptions. And strategic debt management means having specialized restaurant accountants who structure your financials for growth, not just tax efficiency. As of 2026, this matters even more because investors and lenders are rewarding disciplined unit economics over pure growth narratives. This infrastructure becomes your scalability proof. It's what transforms metrics from historical artifacts into predictive assets and turns raw transactions into strategic insight. The paradigm shift is this: stop trying to prove you're profitable and start proving you're replicable. This leads us away from a simple operator mindset, where success is measured by sales and survival, toward an investor-grade mindset, where success means resilient unit economics, disciplined assumptions, and systems that make growth repeatable. Investors aren't buying your current cash flow, they're underwriting your future growth. You aren't just running restaurants anymore, you are building an investable brand platform. Looking ahead, the direction is clear. Restaurant brands that combine hospitality strength with real financial infrastructure will command more attention and better options. In 2026, that means using better benchmarking data, more granular location analytics, tighter forecasting, and technology that turns operations into strategic advantage. The winners won't just be profitable, they'll be legible to capital. Build your financial infrastructure 3 years before you need capital. Benchmark quarterly against segment leaders, stress test every growth assumption, and maintain balance sheet flexibility. When you can articulate not just what your metrics are, but how your systems continuously improve them, you're not just running a restaurant, you're building an investable asset class. So let's lock in your capital-ready blueprint with a simple but urgent call to action. First, benchmark your prime cost against top quartile performers this quarter. Identify your 3-point gap and build a plan to close it through inventory controls, labor flexibility, and purchasing discipline. Second, calculate store-level margins, or four-wall EBITDA, for every location and honestly assess your middle performers. Those are your true valuation drivers, your proof of repeatability. Third, audit your rent ratios and stress test any new site at 75% of projected sales. If it doesn't work under that pressure, walk away before you create an anchor that sinks your expansion. Fourth, cap your debt at 2 times EBITDA to preserve strategic flexibility and build relationships with restaurant-specialized CPAs and procurement platforms before you need them. If there's one takeaway, it's this: stop treating financial visibility as a back-office task and start treating it as a growth strategy. Build the infrastructure that generates investor-grade metrics now, because when opportunity knocks, you can't manufacture operational maturity overnight. Start telling the story investors want to hear, the story of a scalable, self-aware, data-driven restaurant brand ready for prime time. Because when the opportunity comes, the brands that win are the ones already speaking the language investors trust. Like and subscribe for more helpful video like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.